Welcome to another episode of Behind the Designs. My name is Michelle Smollenberger, a financial advisor here at Financial Design Studio. We work with business leaders as they start to think about retiring with tax efficiency. Now, right now, we are in the middle of a mini series of case studies where we introduce you to a fictional client and their fictional situation, and then we share how we would dive in and shape their plan as advisors. If this is the kind of thing that interests you, subscribe to our monthly email where we share different insights and strategies that we use for our clients. You can do that in our show notes at financialdesignstudio.com. Now, I want to mention the first 3 episodes that we've already taken you through. So in episode 65, we talked about someone who's retiring to travel early. And in episode 66, we talked about someone who's relocating to care for aging parents. And in episode 67, we talked about retirees who are repairing some DIY retirement mistakes. So today will be another great episode. Now, if I was trying to use clickbait to promote this episode, I'd say something along the lines of, this is how we've helped clients save thousands in taxes. And the truth is, we have, using a very specific strategy, but it works for a very specific financial plan. That's the point of these case studies, to show you the many different shapes and colors retirement plans come in. There's no one size fits all, and there's no single solution. That's the freedom in designing a financial plan, but it can also be the challenge. So without further ado, I'd like to introduce you to our fictional clients, Adam and Alice. Adam and Alice are inspired by all the strategies we've used to help clients give more money away to their families and to charities that impact the world. So let me tell you a little bit more about Adam and Alice. Now, these are clients who they retired. They're actually in their upper 80s and 90s. So they've been retired for many years. So Adam and Alice were actually both teachers. They're retired. They actually don't have any children. They do have one family member who's still living, but they don't have a large family. And so this kind of makes their financial plan a little bit different when we start to think about what applies to them, or how to make their assets last, or what they should be doing to save in taxes. Now, when they were working, like I said, they were both teachers and they had really long careers as teachers. And so they had those pensions, but they also liked to travel even when they were working. They both are really interested in history, which really kind of it's interesting, it leads a little bit to the giving that they like to do. So that's something we'll talk a little bit more about. But, there's a lot of things that are really meaningful to them, a lot of organizations that are doing great work that they really care about. And so when they think about what do they want to do with the money that they have, giving it away is something that they are really interested in because there's a lot of causes that they want to further. Now, when they were early in retirement, I already mentioned, when they were working, they liked to travel, but something, that they really enjoyed doing was cruises, and not necessarily, international cruises, but even just river cruises, just on nice, kind of smaller, shorter cruises. That's something that they really enjoyed, and kind of going to kind of some more local areas here, even within the United States. And you can see how history ties to even like the cruise environment, being able to go see things that they care about, whether that's around Washington, D.C. or areas like that. This is what I find with retirees, that early in retirement, you might be busy traveling, you might be busy helping grandkids, but at some point, whether it's, right after you retire or later in life, I do find that retirees can sometimes have, a lot of doctor's appointments or their health that they're really taking care of. And so right now, that's something that, kind of keeps them busy. They're not doing as much traveling. They really are busy taking care of their health and each other. And so that's something that I always think through. We work with a lot of retirees, a lot of people who retire. And one thing that I do notice is people who, took care of themselves kind of while they were working, their health was a priority then, and it is a priority now. I do notice that those people kind of tend to, the first year after retirement, they kind of get adjusted. So maybe they're kind of developing a new routine. Maybe, they're not going to work and taking lunch, so they're fixing lunch at home. They're able to kind of be more thoughtful. So they're setting these, new routines of their day. And so I kind of noticed kind of that first year, maybe even 2 years, that people really take to kind of adjust to that new routine or maybe their new schedule. And then as they kind of get into it, then they might start doing that traveling that they've wanted to do. Maybe those trips that they've had planned that they've always wanted to do, or maybe it's just helping with grandkids. So it can be a variety of things. But I do notice that retirees who maybe while they were working, they were really busy. They had families, they had kids that they were taking care of, and they aren't necessarily taking care of themselves or their health. I do notice that sometimes right after they retire, it kind of comes time where those health issues are really surfacing. And now they have to spend, maybe a year or two, and maybe there's some surgeries they need to get done or things they need to get taken care of before now they can actually start to retire maybe some of those travels or some of those things they wanted to do in retirement. So that's just something I notice when, we're kind of talking about retirees, when they retire, and what does retirement actually look like? What do those years after you stop working look like? So that's something that might be interesting, even just something for you to consider as you're leading up to retirement. Is that question of, are you going to be able to answer? Are you going to be able to enjoy those things that you're wanting to do in retirement based on what you're doing now and how you're taking care of yourselves? So one of the big highlights with Adam and Alice that we can definitely take away as they like to give charitably is, just really in general, they're very involved in their community. And so they like to give back financially, but they also always gave of their time helping at museums and things like this. They're also, I would say, they're super savers. And they were, really those people who loved working. They loved giving back, being involved. So when Adam and Alice started working with us, our team walked through the organization phase where we lay out every element of their finances in a chart. And this is where we're looking at each piece of their financial situation. And one of the things that we actually like to do is to look at this without numbers. And what this really helps us to see is kind of the structure of your financial picture. And what I mean by that is a lot of times when you're thinking about your finances, if you ask someone, like, tell me about your finances, if you just generally ask them that, they might say, well, I have this much saved, or I make this much in income. They might pick some of the things that are kind of top of mind for them. But what you also might forget about very easily are things like the insurance that you have in place, or the money that you're saving, but also the taxes that you're paying and how that impacts what you're saving or what you're spending. And so there's a lot of other elements to that, employee benefits, a lot of pieces that we want to be thoughtful of, like even estate planning. And so this structure, as we go through this and we kind of ask and work with a client, do you have these in place? What do you have in place for this? This is where we start to kind of find opportunities, or we start to see things that maybe someone's doing really well. And this is how we can kind of see it without the numbers involved. And then when we start to look at everything, like a net worth, and we start to add the numbers in, that can even start to affect the strategies that we're using too. So actually, I think as an advisor, it's very important to look at your situation as you near retirement to say, what's the structure of my finances with the money that I have, with those numbers, and then without those numbers. That's just something that could be very interesting. When we were working through this with Adam and Alice, I will say that was probably one of the places where we really started to see some big opportunities with them. And I think one of the important things is how we also started to see how their plan might and will be very different than a lot of other retirees. And I'll touch on that a little bit more here in a minute. So that organization phase is really important to go through, get all that information, whether you're working with us or any advisor, hopefully they're asking you for all this information, because that just makes your plan that much better when they know everything that's going on with you, so they can really help to give you the best advice. Now, let's talk through kind of some of their specific pieces as we went through this organization phase. So, what was their retirement income like, or what is it like? Like I mentioned, they both have pensions. They both are in their 80s and 90s, so they do have required minimum distributions, and they actually started taking those back when the deadline or the age to start was 70 and a half. That has changed a few times over the last 5 years. People retiring today might not have RMDs until age 73. But for them, they actually started RMDs when they were age 70 and a half. They both have now some Social Security benefits. This was something even that applied to them as teachers who had pensions. Now, teachers who actually didn't get Social Security because they had a pension, now they might qualify for it. So this is actually something for them. They never signed up for Social Security because they didn't qualify. But this is even something, even today in their 80s and 90s that we're saying, hey, sign up for Social Security because there was a legislation change. And so now that impacts them even more. So Social Security is something now that they'll start receiving, even though they weren't receiving that early in retirement. That was something that, again, when we look at people's plans, things can change over the years. So this was something for them that now they can start receiving Social Security benefits that they hadn't been before. Now, one of the other things, especially with retirees, is we're always trying to look for executive benefits that you might have. So your employer might give you actually some retiree health insurance that you can qualify for, and that just essentially can make your retiree health insurance premiums cheaper. Now, for them, I mentioned they were teachers, and so they do have some access to health insurance benefits that they can get as retirees if they choose them. Now, when we think about investment accounts, what types of investment accounts they have, so, they've got the FB, which is very similar to most people's 401k. Just for teachers, government workers, it's called a 403b, but very similar. You save money into it, and you can deduct those amounts. So 401k, IRA, and then also just kind of a joint savings account. So really, these were kind of the main accounts that they had while they were working, those retirement accounts, and then when they retired, rolling those over to IRAs. And then one of the questions, that we really wanted to understand is, why do they care to give so much money away? And, this is something that's so interesting, and we've loved working with them for several years now. And, even in their stories of travel or their volunteering, and even, how they talk about their love for teaching and the students that they had, there's so many things I think that were driven from their love of what they did and their community and everything they were involved in. And so these are the pieces that are really driving Adam and Alice to say, we really want to give our money away. Now, another big piece of that is that they don't really have a large family. They never had children. And so they really only have one relative who is still living. And so they do want to include them in some way. But for the bulk of their assets, they really want to give that away to charitable organizations. In their mind, it's kind of, we're going to give to our loved ones. We're going to give something and they're going to be fine. That's going to be plenty for them. And so the rest, they really want to leave so that they're able to make a meaningful difference through these organizations that they're going to give to. As we moved from that organization phase now into this planning phase, now we can see kind of all these pieces on the board. We can be strategic about how they're used. And that's really when I talk about that structure, it's really looking at how is this piece over here impacting this piece here. So if I'm saving money here and I'm deducting it here, how does that impact my taxes? But if I'm saving money here, how does that impact my insurance that I have in place? These are all the pieces as we look at this diagram where we can see, what do they have in place? How is it impacting each other? That impacts the amount of coverage you should have. That impacts the tax savings that you can see. So there's different strategies you can use. There's so much information that we need to make sure we're coordinating together, because if you aren't, you could miss a strategy that completely makes sense for them just because we aren't aware of it. So now as we've moved into this planning phase for Adam and Alice, today's case study is the perfect example in how not every strategy works for everyone. If you listen to the last few case studies that we've had, you'll notice there can be some similar things for, a married couple who might have kids, who have saved, they've been super savers, they have a good net worth. And so there might be some things that now we can do that can be common for them. But today's case is so different. And so one of the things, when I talk about kind of a married couple who has kids, Roth conversions can be a strategy that may be popular for them, may be useful. Let's say that you just learned that Roth conversions are something that people can even do, and you start researching it and you start thinking, oh, I need to be doing this because everyone's doing it. That in this example, that would be the exact wrong thing to do. And the reason is, for Adam and Alice, they want to give all their money to charity. So as we start to think through their plan, we're thinking, okay, if they're going to be giving all this money away in the future, so when they give that to charities, we think that through, those charitable organizations, when they give that money away from whatever account that's going to be from, charitable organizations don't pay tax on the money they receive. For example, let's say that you're someone who's just giving stock to an organization. So you've had some highly appreciated stock. You take those 5 shares of that company. Let's say it's Apple Inc. You take those 5 shares and you give it to this organization, whatever organization you choose. When they receive that, what happens is the charitable organization usually wants to sell that right away. Let's say that Apple's at $200 per share. So now those 5 shares, let's say that's worth $1,000. The organization is not in the business of investing their money. They don't want to have this big portfolio of investments necessarily that they've just received, and now they're just going to keep holding like you might have wanted to. When they receive these funds, they really want to put that money into their program expenses, to the mission that their organization represents. And so a lot of times those organizations will receive those 5 shares, they'll sell them right away, and now they have that $1,000 they can actually use however they choose to for their program. So it's very interesting that now, if we were to say, Adam and Alice, let's do Roth conversions and let's pay tax today so that the charitable organization pays less in the future, we would actually be causing taxes for Adam and Alice that they never have to pay at all. And so that's why you really need to be thoughtful of, and why it's really important that for us as advisors, we're going through this process of the organization and then the planning so we can actually see which strategies matter most for you, and even more importantly, which ones don't work for you. So in this case, this is why I love this case study today, because it's really the opposite of what a lot of plans for people do look like, which is just another reason I want to be sure that people know you want to be doing things that really are specific to you. It's custom to you. So one of the biggest strategies, as I just mentioned, we don't want to do for them is Roth conversions. However, we started to think about what are some strategies that we do want to consider for Adam and Alice. And so for them, one of the things is a qualified charitable distribution. So whenever we hear a client who is charitably minded, they like to give money away, we start to think, how can we use their retirement assets? How can we save in taxes while also giving to these charitable organizations? Now, I mentioned those charitable organizations don't pay taxes on the money you give them. So what we're talking about is you saving taxes by using the right type of account that you're giving the money from. And so this is where QCDs, qualified charitable distributions, can really be beneficial. So when we talk about Adam and Alice, that was really kind of one of the big pieces. Now, with qualified charitable distributions, it's really important to know that there's some really cool benefits that you receive. For example, these can lower tax. QCDs can lower your AGI, and why that's important, AGI is your adjusted gross income, and that means that it can reduce your Medicare premiums that you're paying, but also the amount of Social Security benefits that are taxable to you. And so that's why doing a QCD can be so much more beneficial than just giving money from your checking account or giving money from your brokerage account instead. Now, when we talk about QCDs, it's also important to know that there are some rules that you need to know, and you also need to be thoughtful of when you should or when this makes sense. So one of the pieces, now for Adam and Alice, one of the other ways that they could consider giving charitably is just to really simply give money away. And honestly, early in their retirement years, this was one of the biggest ways that they were giving to charitable organizations, because with a QCD, you have to be 70 and a half years old or older. And so you can't do it before those ages. They were retired well before 70 and a half. So there were where they couldn't do QCDs, but they also didn't have RMDs. They didn't have anything that they had to take money out of and pay taxes on. So this actually lined up really well. But for them, they still wanted to give charitably. So for them, it was doing that charitable giving just from their brokerage account or just from their checking account. So from, those pensions, the Social Security benefits that they're receiving each year, they're giving from that. So when you're giving in that way, one of the biggest pieces is that you could itemize your deductions. And so this is where when you're itemizing your deductions on your tax return, you have to be really above that standard deduction amount for it to actually make sense to do. When you're itemizing things, you're really kind of pulling more information together. So it might be mortgage, interest, this charitable. Those are really kind of some of the big pieces, property taxes. If those amounts for a single individual are over $15,000, a married couple are over $31,000, now you're starting to get into a place where itemizing might make sense for you, or it does make sense for you. So this is where with Adam and Alice, when they're doing their giving, they're actually giving a lot of money in each year. And we'll talk about this when I talk about their RMD here in a minute. So for them, itemizing early in retirement was the way that they were actually, going to be able to get the benefit of their charitable giving. So early on in retirement, that's how they were getting that benefit. Now, this is one of the cool things about planning is that a lot of times with retirees, as we like to work with retirees, especially as they're kind of leading up to retirements, they may have, 5 to 10 years before they actually retire because there's so much planning that you can do. Sometimes that planning means that there's things you can do in those years before retirement. Sometimes the planning means that there's things you're going to do in retirement and in different years of retirement that we need to plan for and that will be affected by the things you're doing now. So it doesn't always mean that there's action that needs to be taken, but sometimes it does. So let's talk about kind of this other piece for Adam and Alice. Now, once they've reached age 70 and a half, now they needed to start taking their required minimum distributions from their retirement accounts. And for Adam and Alice, actually, one of the things was that they still had their retirement savings in their 403b. So for them, it was still in that retirement account with their employer. They had not rolled it over to an IRA. And they're 70 and a half. And so one of the pieces or things that they needed to do in order to be able to do a QCD was to actually roll over their 403bs to their IRAs. You can only do a QCD from an IRA. You can't do it from a 401k. So that's something that you do need to know, and you need to plan ahead enough so that you roll those funds into the IRA so that then you can do the QCDs from it. So that's one important step that you need to know about. Now, one of the interesting things for Adam and Alice is that their age for their required minimum distribution was age 70 and a half because they're a little bit older. So that was their age they had to start. Now, one of the things you'll notice is the age that a qualified charitable distribution is able to start is also 70 and a half. So this is one of the cool things when we think about planning over the lifetime for people. We've worked with Adam and Alice for so many years that when they started that RMD, it was age 70 and a half. And when they could do QCDs, it started at age 70 and a half. So what you can see is that legislation as it's made, sometimes and usually it lines up. There's something they're trying to accomplish. So the RMD start, okay, will allow people to be able to give charitably through their IRAs. So in that year, now we fast forward to tax legislation today. Today, RMD start at age 73 to age 75. But you can still do QCDs starting at 70 and a half. Do you see how this can kind of be confusing if you don't know the details and you aren't aware that, something used to be something, and today it's a different age? It's just interesting kind of thinking through the history of how things get set. And I think sometimes it can just help you understand kind of how tax laws and regulations get made, but how some don't always get changed or keep up with new regulations or new things that they're trying to encourage through tax legislation. So let's go back to when Adam and Alice were age 70 and a half. Their RMD started. Now for them, I mentioned they're super savers. So for them, they had RMDs that were really in $100,000 or more for each of them. And so one of the things that, was really exciting for them is they've saved all this money. They're already getting pensions. They don't really need the money that they've saved currently. So they're able to say, we really want to give this money away. So the money that they had as their RMD each year, they were actually able to use that maximum amount. So again, when they started, the maximum amount that they could do was $100,000 in a QCD. Now, if they had an RMD of $100,000, that matched. So what happened is with a qualified charitable distribution, one of the cool things is if you take that RMD, that amount you have to take out of your IRA, anything that comes out of your IRA sent directly to a charitable organization that's in 2025, 108,000 or less is able to not be included in your income. So let me put some numbers to this. For Adam and Alice, they each had a $100,000 RMD that they have to take. So that $100,000, that will be taxable income to them because they're taking it out of their IRA. However, they also said, we want to do a QCD of 100,000 as well. So this 100,000 that's coming out of their IRA, they're saying we want to send that to a charitable organization, but because it's going to a charitable organization, they're not going to be taxed on it. So actually the amount they're going to be taxed on due to this RMD is zero. They won't pay anything in taxes, in income taxes for this RMD. So someone who has a large RMD of $100,000 in 1 year, but wants to give all of that to charity can do so, and they avoid the taxes that they pay on that income completely. And this was one of the really cool strategies. So when we say we're able to save them thousands in taxes, this is what we're talking about. Someone with really high RMDs, but also a really high desire to give to charitable organizations, was really able to wipe out completely the tax implications that they would have had from that high distribution that had to come out of their IRA. One of the cool things each year is kind of like choosing who they're going to give this money to. And so it isn't, for them just something very easy that they're saying, oh, let's just give it all to this organization. They're very thoughtful and careful about who the money is going to. So this is something that's been really exciting to kind of watch over the years and see who they've given to, what causes and organizations they care about. These are some of the planning strategies. As we've thought about their plan, these were some of the ones that really made a big difference in the taxes that they paid. Now, some of the other planning specifics for Adam and Alice was actually that they didn't have estate planning documents. So this was something that was, again, very important because they do care that their money is going to organizations. And so we wanted to be sure they get estate planning documents in place so that the money gets passed to each other first and then to those organizations whenever they pass away. So that's something that we really needed to get in place for them as well. Now, one of the interesting things that when we're talking about retirees is that, your health care is going to change, your health insurance, for example. So while you're working, you have your employer and you get your health insurance through them. But then when you retire, you say, I still need health insurance. However, once you turn age 65, you sign up for Medicare and you're Medicare eligible. So you need to sign up. And then you basically get kind of this Medicare Part A, and then you pay a little bit for Medicare Part B. Now, when I say pay a little bit, it depends based on what your income is. So that Medicare Part B premium is based on your income. So when we're talking about Adam and Alice, and we're talking about someone who has high income from pensions, they could have high income because of these retirement distributions. We can easily see how their Medicare premiums could be the highest that are possible, or they're going to be in one of those higher brackets. And so this is something that we're also trying to work around. One of the cool things is that QCDs actually help, as I mentioned, they minimize your AGI, that adjusted gross income. So it's also helping to bring their Medicare premiums at least down to a more reasonable level and not to a high level that it could be. So again, we're accomplishing something else. Now, one of the cool things over the years is there's been different ways they're able to give. And this is probably something that I really want to highlight, for them specifically. When I mentioned, they were early in retirement and they wanted to be giving money away still, right away, they were still able to deduct that on their tax return. Then once they reach that RMD age, so 70 and a half, now they're giving through QCDs. And this is where, at different points in their life, they're giving still, but they're giving in different ways. And then once they pass away, their estate planning, the money that's left, is going to do the rest of the giving for them to make sure that those funds go where they want it to go. So I think this is what's really unique, especially even, when we talk about, business leaders who are retiring from a company and they might have, again, they have giving they want to do. One of the interesting things is you can have highly appreciated stock in some of those accounts that when you give that away, just like these QCDs, you avoid the taxes that you pay on that because you're giving it to a charitable organization. And so, very similar to Adam and Alice, as some of these other case studies that we've talked through, some business leaders and executives also have very similar examples of giving that they can do at different points in their lives. So early in retirement, it might be using those accounts that they have, like brokerage accounts, maybe even some stock they have in their 401k, pieces like that you want to handle very carefully. And then later in life, it could be QCDs. And so we're just using different types of accounts at different times to do the same thing you're trying to accomplish, which is giving charitably. Now, finally, we kind of get to this implementation phase. And so as we work with clients, we like to say all year, every year. That's really the benefit, is that as things change, as legislation changes, and as new opportunities come available, you can incorporate those into your plan. Over the years, as we've worked with Adam and Alice, we've circled through kind of this organization, strategy, and implementation phase really a couple times as things change. And so this is where, nothing is set in stone. I will guarantee you that most retirees, if not all, something in their plan changes. And whether that's they decide they want to buy a second home, they travel somewhere and they actually want to stay for a longer amount of time, and they actually want to take their family with them. And so now that's going to cost a lot more. There are so many ways that retiree plans can change once you're actually in retirement. And so these are some of the things that for us, honestly, are exciting, because one of the biggest pieces that we enjoy is hearing how you're living life, how you're enjoying the things you're doing. And so when we hear retirees, when they come back and we're updating their plan, and let's see how that looks. Now, for Adam and Alice, they could decide we're still going to give that 100,000 per person away to charitable organizations. However, in some years, and in this year, they're saying, you know what, we actually want to buy a condo downtown on the lake because we really love being downtown and we want to buy something that has a great view. We really love being a part of the city. Again, that's their community. That's kind of the things that they enjoy. So now when we do their tax analysis, we can actually show them, okay, well, let's see what that looks like if we don't give that amount to charity and we pay taxes on that. How much are we talking in taxes? And then in 2 years, what are we looking at with Medicare premiums? Those are the pieces that we have to be thoughtful of, is how it's going to impact the plan when we make those changes. Let's look at the plan. Let's see how it makes a difference. And let's see if you still want to do it. Being able to see something can make a really big difference in how confident people feel about the things that they're wanting to do. I think this is one of the cool things that as you look over the lifetime of a plan, I love when we have clients who have been working with us as long as Adam and Alice have, as we can look back and we can see all of the decisions, the things that have changed in their plan, their year by year choices of who they want to give funds to, or if they want to give funds to organizations, or what they want to use it for, is always changing. And I think that's what, for me, honestly, is exciting to kind of look back and see how things have changed, but also how everything that they set out years ago that were important to them are still important to them today. And with that RMD amount, we could easily say, oh, what organizations are they going to go to? They're trying to give this money to organizations. They really want to make sure that it's making a meaningful impact in the mission that they want to support. So a lot of times, they may come in with a list of, can you look this organization up? And then we look at that website of the organization and we see, for example, what are the administrative expenses or costs that organization has? And what are the program expenses? So we can easily see, is 80% of every dollar that's going to that organization, or is it 60%? So these are just things you have to be thoughtful of. There are different websites. We will list some resources in the show notes of this podcast so you can kind of, learn some of those. But this is where, these are kind of some of the pieces on a year by year basis that they're really making decisions about and they're trying to decide. And even as they think about their estate plan, I mentioned they're in their 80s and 90s. And so these are things they're thinking about in our estate plan. They've changed the organizations that they want to give to over the course of their plan. So, back when they were 65, 70, and they had their estate plan set, or the organizations they had as beneficiaries, that's changed today. And so with your estate planning documents, with their estate planning documents, they can always decide, who do we want this property to go to or this new condo we're going to buy? Who do we want that to go to? And then any remaining retirement assets, who do we want to receive those? They still have a lot of life left. They're still very energetic. And that's what's honestly, again, exciting to hear. Even with this new idea of like, hey, we want to buy a condo, they intend to make the most of it. These are the things that they've always cared about, being in their community, being involved, caring about organizations and the mission that they're trying to accomplish. And so they're just continuing to live that out, even now when they're well into their retirement years. And I mean, one of the things that when you've lived that long, and you've seen so many things and you've been involved in so many things, there's so many great stories that they can share. That's one of the things that I know I enjoy getting to listen to is their stories, but also just laugh at some things that have happened along the way too. So for Adam and Alice, this is kind of one retirement case study that is so different than the last few that we've talked through. And that's why we really wanted to be sure and highlight this one. This is the type of planning that we love doing, planning what you have and how to pay as little in taxes so you're keeping as much as possible or you're giving as much as possible away. But for Adam and Alice, they're a lot of fun to work with. There's very different pieces to their plan. And this is why I would just encourage everyone to really think about, their situation. This also might even just inspire you to kind of start to think, is there some type of giving that we want to do? So that brings us to the end. In our next episode, we're going to have another case study where we talk through how we helped a recently widowed woman take control of her finances. So stay tuned. If you're someone who's starting to think about retirement but isn't quite sure what you're missing, that's where a team like ours can help you. We take care of your finances so that you can confidently enjoy your life knowing you are on track. So schedule a free consultation on our website. And until then, we'll talk to you in the next episode.